Well, with great pleasure, let me now welcome a very special guest on ET Now, James Sullivan, JP Morgan, Head of Asia ex-Japan Equity Research. James, it's your first time on ET Now, so a very warm welcome and thank you for joining us.
Thank you for having me.
James, in your latest note, JP Morgan Equity Research team seems to be making a case that emerging markets will outperform developed markets in the second half. So before I get into specifics, why don't you paint the big picture for us? What's the thinking behind this call?
Sure. So there's two comments that I'd make. First, I think we have to be very cognizant of where we're coming from and what relative performance has looked like over the course of the past few years. And then second, what is the key driver of performance moving forward? So from a positioning perspective, we have to take into account the fact that emerging markets have underperformed developed markets by over 50% since 2010. Interestingly, on a year-to-date basis, we've seen 5.5% outperformance, which is the best start to the year since about 2009. So we're starting to see the early stages of a change in trend. Now, what's the driver of out or underperformance moving forward? It's almost always growth differentials. And so it's important that we take a view on both sides of the coin. On the developed market side, primarily driven by the United States, I think we have to be cognizant of the fact that profit margin proxies went negative in the fourth quarter of last year for the first time since 2008. In addition, one of the largest drivers of EPS growth in the United States has been share buybacks. Announced share buybacks on a year-to-date basis are 150 billion US dollars. That's only 50% of where we were this time last year. Another critical component of the developed market story that we really don't feel is well understood is the leverage component. Most people will look at a market cap weighted index when they look at leverage, and on that basis it looks fine. However, if I look at the median leverage of the median company, that's at the highest level that it's been in over 25 years. The differential is caused by a number of very large tech companies that are very cash rich. And so the drivers of earnings growth in the United States are clearly starting to fall back. Across the emerging market space, we now have 22 emerging markets around the world from a sector perspective where we're seeing positive earnings revisions. We're seeing both monetary as well as fiscal stimulus, which is a very different situation than we see across the developed markets, both being put into play across the emerging market space. And so we're confident that the early stages of outperformance that we've seen on a year-to-date basis will extend throughout the rest of the year.
James, most of the emerging markets, at least the big ones, are largely dependent on exports and commodity prices. Given that global growth is still anemic, the export demand will remain poor, and commodities, they are in a bear market. So what really would propel the earnings picture for emerging markets which are dependent on exports and commodity prices?
No, it's a great question, and I would like to come back to the export-driven nature of these markets in a second to highlight some of the risks from a longer-term perspective. From a short-term perspective, we're seeing a number of the major emerging market economies, China as an example, really start to move away from an export-driven growth to a services and consumption-driven growth model. Now, we're still very much in the middle innings of this conversation. However, services took over leadership of the Chinese economy, as an example, in 2013, and are really the driving force behind the country. And if I look at, in particular, the structure of some of the equity indices in these markets, they're actually far more tech and new economy biased than most people realize. The inclusion of the ADRs, for example, into MSCI China has created an index that's one of the most tech-heavy in all of Asia, which takes some investors by surprise. If I look at the commodity cycle, I think the most important thing that we're arguing is that we're seeing a basing out of the commodity cycle. We have seen very strong price improvements in segments like oil. We're starting to see some stabilization in steel. We're not seeing broad-based improvement. Our argument, particularly in commodity-heavy markets like China, is that basing out is enough to start to set the stage for success. We've had such a dramatic drawdown in commodity prices, which has had such a negative impact in terms of economic growth in some of these markets, that simply basing that out creates an environment for improvement moving forward.
James, are you making a case for a structural shift towards emerging market equities, or your call is more like a tactical call which has a shelf life of about 6 to 12 months?
So again, another great question. I think what we have to recognize is on a short-term basis, the weakness in growth that we're seeing across the developed market world, as well as the confluence of both fiscal as well as monetary stimulus in many emerging markets. And so you're seeing a $400 billion infrastructure program put into place in Indonesia. You're seeing the Duterte administration in the Philippines increase infrastructure capex by 50% over the course of the next couple of years. You're seeing infrastructure spend in markets like China and India as well. That confluence of fiscal and monetary policy stimulus is extremely good for EM outperformance over the next couple of years. The fundamental or existential question that we need to get our heads around, however, is on a country-by-country basis, these markets moving away from an export-driven model, which is clearly starting to stall out. The export-driven model has seen almost every emerging market around the world pursue export-driven growth. We're now at a stage where we simply have the capacity to make too much stuff, and we don't have enough people to sell it to. And that's driving the overcapacity statistics that we're seeing across global emerging markets. What we're seeing in specific markets like China is, again, very specific policies put into place to segue to a services and consumption-driven economy. If I contrast that with what we're seeing in a market like Indonesia as an example, I previously referenced a $400 billion infrastructure program that's being put into place, which is obviously extremely supportive of growth in the short term. However, we need to question, is that infrastructure spend focused on transitioning this economy to a new growth model, or is it still focused on the old export-driven model? Well, the answer is the two largest segments within that infrastructure package are, number one, roads, two, ports. So still very clearly focused on that old export-driven model. So it is conducive to growth in the medium term. However, we would like to see more concrete signs that we're segueing to a new growth model in particular markets.
That's a brilliant point. So let me just throw in India. According to most of the brokerage opinions, and if I scan through the house report of JP Morgan, India seems to be the preferred market. But do you think somewhere Indian equities are now crowded? And if you're buying into Indian stocks, you are actually buying what is typically called as a cherry consensus?
It's an excellent point. I think the critical component of our overweight call on Indian equities at this stage, you're absolutely right. Sentiment has clearly started to turn. It is a far more consensus overweight market now than it was a year or so ago. The critical component of our overweight call is the resumption in earnings growth. And on our numbers, we have a 15% year-on-year EPS growth target for MSCI India. That compares to zero or effectively negative growth over the course of the past couple of years. And so if we go from that extremely low growth environment and we see a resurgence to the 15% earnings growth for the market as a whole that we're looking for, that we do think we will see continued outperformance of the Indian market, but it really comes down to that growth statistic.
Really appreciate your time. And thank you for accommodating this interview request. Thank you very much, James.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.